Today we're going to take a closer look at 4 stocks on my watch list this week for potential buys. Like many of you, I put money onto my account on a weekly basis, looking for either new investments or old investments to increase my overall position size. So we're going to take a closer look at one cybersecurity, one semiconductor, one e-commerce, and one advertisement giant. And before we go any further, let me know in the comments below what are some stocks you're planning on purchasing this week.
I do want to thank The Motley Fool for sponsoring this video, and make sure to check out fool.com/Jose to get the top 10 stocks to buy right now.
Before we go any further, I do want to say thank you to all my viewers. Today is my 30th birthday, and I can't imagine doing anything else but YouTube and kind of talking about semiconductors and talking about stocks. For those not familiar, I come from an engineering background. I have my master's degree in electrical engineering, and while I do enjoy engineering, I enjoy the overall stock market and kind of creating this kind of content a lot more. And about a year ago, I was able to kind of make the full transition. So I just want to say thank you. You, the viewers, have given me one of the best gifts, and I truly appreciate it. And if you guys want to support a little bit more, just hit that thumbs up. It's free, but it helps me grow my overall audience. Share this video with whoever you want. If you want to support a little bit more, make sure to subscribe using my link at fool.com/Jose. So the first stock we're going to take a closer look at is Qualcomm, the semiconductor giant, ticker QCOM. We can see right now the stock is down roughly 1.4%, but we can see from its 52-week high, the stock is down roughly 28% at the moment. Our current market cap of $153 billion and a dividend yield of 2.2%. So I think Qualcomm can excite numerous investors. The first one are those looking for a dividend yield. We can see a nice yield at the moment, but the second are growth investors. Qualcomm has numerous growth opportunities, which I'm about to discuss. So if we take a recent look at their most recent quarter, which they presented on July 27th, so about a month ago, we can see revenue grew about 37% year over year. This is a company that has been growing their revenue at crazy levels, with about $10.9 billion this quarter alone. One thing about Qualcomm I do want to say is they depend a lot of their revenue at the moment with handsets, so mobile devices, and as consumer spending is expected to decrease, we can see while some investors might be a bit fearful of Qualcomm, but they do offer some other markets. For example, Internet of Things, which I believe is going to be a huge play for Qualcomm in the future, and then their automotive market, which at the moment is the smallest portion, a $350 million revenue segment, but they have over $19 billion in design win pipeline. So if we take a closer look at their Internet of Things revenue, this is one that can be used in numerous markets like compute, XR, wearables, consumer electronics, industrial retail, smart city, energy, manufacturing, edge networking, and so much more. The company believes by their fiscal year of 24, this segment will be over a $9 billion revenue segment, and I do believe that is extremely possible for Qualcomm. For those not familiar, Qualcomm does design processors. Their processors are mainly used in the mobile devices right now, but they are trying to expand into the computer, the desktop, the laptop area. And in mid-August, there were reports that Qualcomm is jumping back into the server CPU market with the recent acquisition they made about a year ago of Nuvia. So at the end of the day, those are just reports, but it does show the optionality that this company could go, especially with their ARM-based processors, which are kind of getting traction not just in the mobile space, which they're already a clear winner there, but more into high performance computing like data centers. So Qualcomm is one in my portfolio already, and it's one that I've been adding for the past few months. I'm still trying to increase my overall position in this. So this for the next few weeks is going to be one I'm going to keep mentioning on my side because it's one I'm going to keep adding onto. The next stock is one that's also in my portfolio and one I want to continue to increase my overall position size, and that is Meta Platforms, ticker META. We can see from its 52-week high, the stock is down a whopping 58%, sitting at a market cap of $430 billion. So Meta has seen numerous headwinds. First, macroeconomics affecting advertisement spending. Then you had the changes in iOS. Then you have the competition of TikTok. Then you have kind of the CEO and management really focusing on virtual reality, augmented reality, and the metaverse, and some people might not be excited about that. But before we go anywhere, let's take a closer look at this company's balance sheet. We can see trailing 12 months cash flow from operations was $58 billion in the trailing 12 months, roughly $40 billion in cash and short-term investments, and zero debt in their most recent quarter. For those familiar with Meta Platforms, you are familiar that in August, they did raise about $10 billion in senior notes. So we are going to see their balance sheet shift a little bit, but again, this is nothing, in my opinion, that's worrisome. I do believe this company is still financially stable, but I can see why some people are worried with the overall increase in debt, and while they are losing a bit of revenue at the moment and also burning cash in that virtual reality labs. First, let me say why I'm excited about Meta platforms. If you have any time and if you commute, I would definitely recommend taking a closer look at the Joe Rogan podcast, where he does discuss with Mark Zuckerberg for roughly 3 hours, and Mark can kind of show how much of a visionary he is. Obviously, certain people might not like him, they might not like the way he's doing things, but one thing I do want to say is he's definitely a visionary, especially when it comes to virtual reality, and you can see how focused he is in this space. Now, if this space is where the company should go, now that's a different story, and every investor might have a different answer. But if we take a closer look at their recent products, we know from their most recent earnings that they are seeing good traction with their investments in artificial intelligence. It's helping them kind of keep customer engagement and customer experience well, especially with the Facebook Shorts or Facebook Reels that they're doing to kind of combat TikTok. So while they are investing money into the future, they're also investing a lot of money into data centers, artificial intelligence right now to be able to continue to be a leader in the space, and I like that a lot. So the third company we're going to take a closer look at is one that kind of hits the cybersecurity space, and this is going to be OKTA, a company that deals with user authentication. Currently a market cap of $14.3 billion. We can see from its 52-week high, the stock is down roughly 67%. I do want to say in the cybersecurity space, these are companies that I believe in the future have huge potential of being acquired by bigger players. I'm not purchasing OKTA for acquisition news, but I do believe this can kind of create a baseline for my investment thesis. So we can take a closer look at OKTA. Positive cash flow from operations in trailing 12 months, more cash and short-term investment than debt at the moment. If we take a closer look at their most recent earnings, and they are expected to release earnings this week, so for those kind of interested, maybe take a while and listen to their upcoming earnings that should be, I believe, Tuesday or Wednesday. But we can see total revenue compounded annual growth rate from their fiscal year of 2020 to the fiscal year of 2023 estimate is roughly 46%. I believe that is insane. If we take a closer look at their most recent earnings, which were about 3 months ago, revenue grew 65%, subscription revenue grew 66%, trailing 12-month dollar-based net retention rate was 123%, total customers grew 48% year over year, and customers with over $100,000 of annual contract value was up 59% year over year and was also up quarter over quarter. So OKTA is a small position in my portfolio, but it's one that I want to increase now over time to make it a bigger player. The fourth company is probably the one that has the most risk in my opinion, but I also do believe it's the one that has the most growth opportunity, especially at the levels it's at right now, and that is Shopify, ticker SHOP. First, let's start off with this quick balance sheet. We can see positive cash flow from operations, huge amount of cash and short-term investments, and very low debt. So this allows me to be comfortable with this company being in the growth phase and kind of invest a lot of money within itself at the moment, because they do have plenty of cash and short-term investments. If we take a closer look, revenue the most recent quarter only grew 16% as numerous headwinds are affecting the company. The overall kind of macroeconomics are affecting consumer spending, which is obviously hitting the e-commerce side. I do want to say the challenges that Shopify is experiencing right now is not due to competition, it's more due to macroeconomics. And that actually excites me because it's not from competition, and usually the strong players are the ones that survive during the crazy downturn in the market. So when things get back to normal, I do believe Shopify is going to have less competition and is also going to be a lot stronger due to its overall financial health. I know some people might not be excited with the amount of money Shopify is using into the logistics market, especially when you have a huge competitor like Amazon. But I personally do believe this is the right move for Shopify because they are kind of creating an all-around solutions for anybody who wants to create some form of e-commerce or just form of side hustle or business. So again, I do believe Shopify is the one with the most risk out of the four, but it's the one with the most growth opportunity. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.